Welcome to TheoTrade. This is Don Kaufman. Here we are, September 11th, 2017, with the S&P futures just a few minutes to go to the close, up about 23 handles. However, the shell game continues on, and I'll point out precisely what that means here momentarily. Nevertheless, call this rally what you will. Is it okay? The hurricane kind of relief rally? Quite possibly. A few proponents in the market mentioned that it could be the fact that tensions have no longer increased with North Korea. Again, everyone is always looking for a reason, ultimately, for why the markets are perpetuating and making certain moves. In the end, okay, we took off pretty much out of the gate this morning, and we haven't really looked back. Again, the S&P futures, and I'll bring this up to a bit of a broader chart, are right at the all-time closing high. So specifically, again, S&P futures at an all-time closing high. They ultimately opened right at that kind of magic number we've talked about a tremendous amount, which was 2466, something we've been mentioning kind of week in and week out. Now, let's get to the aspect of what we kind of call the shell game. And this has a lot to do, if we look down the list, some of the usual suspects we've been talking about. One of them that we've, of course, had our eye on a tremendous amount have been the financials. So let's zoom into the financials here. And most appropriately, I like to look at the financials, and I typically like to look at different sectors on a year-to-date percentage. So at this point, again, here we are. I've pulled up year-to-date, and I've actually switched the scale to percentages. So the XLF comes off hard and fast over here, okay? And I'll point this out once again as the XLF comes down, peaked out on the year just about like 8%, got all the way down. It was only up 1%. And again, we're just 2 days removed for that. Ultimately, the XLF having a bounce to the upside. This is part of, again, what I kind of call the shell game, and that is capital leaving it. All right, this sector, capital now popping back in. And when you start to look at this, again, at this point, let's just isolate the XLF. This looks kind of like a bearish bounce where quite possibly, again, the XLF comes in here in the next couple of days. Now, before I go any further here, so we see this big bounce up in the XLF. Okay, the bounce overall in the markets, how does that fit in with the expected moves? Now, again, expected moves, for those of you that don't necessarily tune into the evening videos day in and day out, the expected moves are derived from option premiums. This week's expected move, again, this week's expected move is just over about $30. Now, let's actually look back for a moment here and show in last week. Last week, the exact opposite occurred. We opened last week straight down, bounced back up right inside the expected move, and kind of landed again on the week right around 2460. So this week starts at 2460. Right out of the gate, we're all the way up again now on the SPX, 2487 and change. We're just shy of the expected move for the week. And the expected move for the week, you can see, is right north of 2490. Again, just north of 2490. The reason, and again, before I talk about like a little bit of the shell game here, the reason I'm bringing up this expected move is, again, we're just shy of the expected move. If we do start to hit the expected move, have expectations of markets coming back in as the week progresses. Again, that would be the exact opposing of what we saw in the previous week's trade. And we've actually seen quite a bit of this lately, where we're coming up again to the edge of the expected moves and coming in, okay? Again, week after week, very, very similar fashion, where we've come right up to the edge of the expected move, or to the lower edge of the expected move, and kind of come in. Now, moving forward, as I was kind of mentioning a bit of the shell game, so capital is just flooding, out of XLF and literally right into the bonds. And this is what I was referencing in terms of the shell game. So now all of a sudden we have capital coming back out of the bonds in quite a big way today. I mean, it's one of the bigger moves we've seen in bonds. It's down, you know, a 1.12 tick. So now capital's back out of the bonds. Now, bear with me here as I show this. It's out of the bonds, back into the financials. So again, you have to respect this because these are correlations that had not played out in a very, very substantial period of time. This move that we're seeing right now between bonds and the financials, that is much more prototypical of a functioning marketplace. And again, the reason I bring this up is if you look back through history, again, the prototypical move is when bonds are rallying, okay? When bonds are rallying, the XLF, okay, more often than not was down, okay? There's the closing bell. But lately, what we've actually seen is bonds up, XLF up, okay? But here, all of a sudden, that, you know, almost perfect capital rotation is coming into play where the XLF is ripping higher, okay? And the bonds are off. But I'm also seeing it in a number of different products. I'll give you an example. Something like Google, which in today's trade can't get out of its own way. So we see a marketplace and the S&Ps are up 1%. The Nasdaq is up over 1%. The Russell is actually weak on a relative basis, which is quite curious. But Google is relatively unchanged on the day. And when I say there's shell game, well, yeah, that's because capital today was into Amazon, or you can make an argument it's into Tesla, okay? So again, respect the fact that huge rally right out of the gate, okay? However, this huge rally could be met with a bit of resistance as we come right into the edge of the expected move. And that's really what I want to leave you with as we kind of progress through this trading week, okay? In addition to leaving with this idea, if we progress up to the edge of the expected move, and again, that's right around 24.93, okay? At that point, can the markets progress? And I'm going to go over to the spiders over here, but can the markets progress through the expected move? Could we have an explosive move through the expected move? And the answer is yes. Without unequivocation, sure. Okay, not to mention Apple's got some big news tomorrow. If you're looking for a trade, if you're looking for a hedge to the upside, there are a number of positions that you might want to employ. One of those would be a ratio back spread to the upside. However, these September options, okay, with 4 days remaining, they have risk if you're going to go out and try to do a back spread. It's because there's a dividend payable. So if you're going to do a back spread, all right, that would be selling a call and then buying two further out of the money calls. I would not suggest using the 4-day options. I would go out even as far as the 11-day options and kind of play around with the idea of the back spread out here. And what a back spread might look like, okay, is something along these lines. And again, I'll come over here and I'll analyze the trade. And I've got a number of different positions on here, so bear with me as I take you through, hide all the positions, and just show you, of course, this ratio back spread. All this trade happens to be, okay, is either positioning yourself for an explosive move to the upside, okay, or number two, this could be a hedge to the upside. Again, it's notable. I am using the SEP 22s. Okay, that's a 49.5 251 call. So I am selling one of the 249.5, buying two of the 251 calls for a 22-cent credit. Yes, the trade is being done for a credit, but this trade still has risk. Okay, where is the risk in the trade? It's often what we term the valley of death. And in any ratio back spread, you're going to have this, where ultimately, okay, if the market sits right at 251, we could take some heat. The way to avoid that is to exit this trade, okay, 2 to 3 days before, okay, the expiration. Just exit the trade 2 to 3 days before the expiration, and this valley of risk, okay, won't really impact you. Again, this trade can be used for upside potential or a hedge. Last, but definitely not least, in putting a trade on like this, if the market stays flat or goes down, you still get to keep the 22-cent credit. Again, think about it, because at times like this, you're seeing the market explode. Is there the chance it blows to the upside and we have this big, blow off marketplace? Absolutely. And that's why we use trades just like that ratio back spread. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.